So in my previous video, we learned that the stock market offers tremendous upside potential, like what we saw during the 80s and 90s. But if you're retired or retiring soon, a bear market, like what we saw during the 2000s, can lead you to running out of money if you take on too much stock market risk. But basically, it seems like maybe 50% stocks and 50% bonds. This seems like a good allocation ratio for retirees. This is also what I hear Bob Brinker recommending. But if you're younger, perhaps even in your 40s, and not drawing on your savings, there was not much downside risk to being perhaps 80% in stocks and only 20% in bonds, even though 40% stocks was the best allocation ratio from 2000 to 2017. But what about other bear market periods? So this time we're going to look at two more bear market periods, 1966 to 1982, and then 1929 to 1945, which includes the Great Depression. And so 1966 onward might catch your eye because this was a rising interest rate period. You know, we keep hearing from people today talking about bonds being in a so-called bubble. Everybody's worried about interest rates going up. And of course, when interest rates go up, bond prices go down. But if you own a total bond market index fund, they're not going to crash like stocks can crash. But until interest rates normalize, you're going to just have overall lower returns. By the way, I should note that in all of my charts that I show you, I use 10-year Treasury bond returns, which are going to be more volatile than a total bond market index fund, which currently has an average duration of only 6.1 years, not 10 years. The other thing about 1966 that made it extra tough on investors was that these lower bond returns were coupled with high inflation. So you needed to take out more and more from your savings to keep up with your expenses. So you had two things working against you. And just to show you, with 4% being $4,000 in 1966, by 1982, 4% was $12,258. But so just when you thought it was safe to be perhaps 50% in stocks and 50% in bonds while taking out 4% per year pegged to inflation, your portfolio was dangerously down to $65,000. And I already covered it in this video, but basically from 1966 onward, you had to either live on a fixed withdrawal rate of only 3.4% in order to maintain the value of your portfolio, or you had to later ease up on withdrawals. By the way, if the fact that the 4% rule technically failed is making you want to dump your money into an annuity, today's immediate annuity didn't even come close to doing any better. And this is something that insurance salesmen always omit telling you. Again, you can learn why in this video. Anyway, as you can see, whether taking money out in retirement or just letting your money grow and compound, 100% stocks was the best allocation ratio from 1966 to 1982. Next, we look at the Great Depression, and in this time period, first of all, unlike 1966, which had high inflation, we had deflation in the early 30s. In fact, if 4% was $4,000 in 1929, by 1945, 4% was only $4,209. Now, everybody is familiar with how stocks got clobbered, but bonds did their job and provided consistent returns during this era. And as you can see, if you were taking out 4% per year and rebalancing once per year, 90% bonds was the best allocation ratio. And as bad of a stock market crash as we had back then, notice how 40% stocks was the best allocation ratio if you were leaving your investments to just sit and grow and compound. So once again, like we learned in my last video, if you're a younger investor, it makes sense to not be afraid of the stock market. Even if you were 80% in stocks, you only lost, $17,435 by not being 40% in stocks. Not bad considering that stocks dropped 89% from 1929 to 1932. Now, as for you retirees who are absolutely dependent on having your nest egg to last so it can continue to work for you to provide income year after year, even at 40% stocks during the Great Depression, you only lost out on about $7,800. And then again, we look at 1966, where if you didn't brave up and take on some good stock market risk, then you absolutely got punished. And this is why you hear many advisors today suggesting that in today's low interest rate environment, you really need to think about taking on more risk than usual by allocating more into stocks. And you have to be prepared to possibly have to live on less than 4% withdrawals in retirement. Again, 4% is an arbitrary line in the sand. And just because you might have to take out less at some point certainly doesn't mean that an annuity is better. Index annuities and immediate annuities are nothing more than a guarantee to leave you in poverty later in life. By the way, also keep in mind that interest rates could still go sideways for a long time, or if they go up, they could go up slowly, not that high, and so the bond portion of your portfolio shouldn't take a 1970s-like beating.